Good morning. We will pay attention to the theory of partnerships. A partnership is formed between 2 and 20 partners. A partnership agreement will be drawn up, and that will determine how the profit will be divided between the partners. So in this partnership agreement, they will indicate what is the salaries of each partner, what is the interest on capital, and how they will divide the profit. When you complete the final accounts for partnerships, you should use the following steps because it will make it easier not to make any mistakes. First of all, we've already got the ledger accounts and a trial balance. So we will complete adjustments for any of the entries that was not completed or for corrections at the end of the year. Then we complete a post-adjustment trial balance. We complete closing transfers to close all the nominal accounts to the trading profit and loss account. And then we will determine the net profit. So the first 3 steps are exactly the same as the steps that you will follow when you complete the financial statements of a sole trader. From step number 4, we have additional information. So in step 4, we've already calculated this net profit in the profit and loss, and we will transfer it to the appropriation account. Because in a sole trader, the total profit that you make in the profit and loss account will go to the capital account of the owner. In a partnership, we have different partners, so we have to divide that profit between the partners, and that division of the profit between the partners will be shown in the appropriation account. We complete adjustments for the expenses that must be paid to partners, that is the salary and interest on capital. So expense is always debited, so we will debit the salary of A, the salary of the partner B, and we will complete the interest on capital on the debit side. And then instead of crediting accrued expense, because we still have to pay these expenses, we will credit the current account of the partners. So that's very important with partnerships. Any expenses that must be paid to the partners will not be recorded in accrued expenses. It will be recorded on the credit side of the current account of the partner, so that we can determine at the end of the year what is the total amount that the partners are entitled to. After we completed this adjustment for the salary and interest and transferred it to the current account, we will complete closing transfers to close the expenses, salary and interest on capital, and transfer these amounts to the appropriation account. Because in the appropriation account, you will have the profit for the year on the credit side, and any money that's paid to the partners will be recorded on the debit side of the appropriation account. So say for instance the profit is 200,000 and the salaries is 80,000 and the interest is 10,000, then it means we've already used 90,000 for the partners to pay their salary and interest. We only have 110,000 left over, and that's what we do in step 7. We determine what is that remaining profit. So the net profit less the amount paid for salaries and interest to the partners. And we then transfer these amounts to the current account. So we first of all determine what is the total profit that's left over. Then we divide it according to the profit sharing ratio, and we transfer it to the current account of the partners. So on the credit side of the current account, we show all the amounts that is owed to the partners. Then we will transfer the drawings to the debit side of the current account. That means we say they've already taken some of the money that they're entitled to. And if we then balance the current account, it means that we can determine what is the outstanding amount at the end of the year, that the partners are still allowed to withdraw out of the business that they're entitled to. And if it's a debit balance brought down, it means that this partner took more money than he was entitled to, so he actually owes money to the partnership. Then we will complete the income statement and then the balance sheet, and then we will complete the notes that will accompany the financial statements. What is very important is that the note for current accounts is a summary of all the transactions in the current accounts in the general ledger. Therefore, the answer in this note must be equal to the balance in the ledger account. If it's not equal, it means that you made a mistake somewhere.